All right. Good afternoon, everyone. Rich Swerbinski with the Mortgage Collaborative here with the Last Week in Mortgage Today, our weekly kind of whirlwind through all things mortgage industry. Each week, I am pleased to be joined by one of our lender members as my co-host. And this week, I have the first ever TMC member and the chairman of our lender board of directors, the CEO of Panorama Mortgage Group, Jason Madiedo. Jason, good to see you, man.
Good to see you, Rich. Thanks for having me here. It's looking forward to our little chat.
So much to get to, so let's get right into it. Obviously, any questions, comments, anything anybody has throughout the course of the show, please feel to drop it in the chat or the Q&A, and I will voice it aloud and incorporate it. But Jason, how can I not start with the United Wholesale, Matt Ishbia, bend the knee, mandate that you can't do business with Rocket, you can't do business with Fairway. I mean, to me, it's just so ridiculous because the whole premise behind the broker channel is lower price options. You have this marketplace of lenders, but not these lenders, evidently, according to UW. Your thoughts on that insanity?
Yeah, I mean, real quickly, I think it's, I guess it's proof that we are in the hearts and minds business, right? Because it's all about emotion and how you feel. It's interesting. I don't have much to comment on that, Rich. A long time ago, when I've been married for 23 years, and my mom told me, don't ever talk about your fights that you have, because all your family and friends will only remember those things and not all the good times you have. So I'm not sure if that's as relevant, but what I'm saying is probably shouldn't air out some of your griefs publicly because people will remember. And I think, putting customers in probably a weird position, to say the least, especially as you said, it's an industry, or it's the market, especially the wholesale market, is about getting the best price, about a broker working with the best partners. And so that's going to be interesting to see how it plays out. But, I think it's just like a bar fight's happening, and I'm, going to just scoot underneath the whole fight and just get to the bar so I can serve myself a drink.
I got a lot of nice comments from Fairway people this week that basically were just, this was like great publicity for us, and I guess so. They were kind of shocked that they got called out, but
what's the saying? Even bad publicity is good publicity. I don't know, something like that.
Right, and somehow UWM, Rocket Mortgage, $9.4 billion in profit last year, the number one market share mortgage lender in America. They've managed to create sympathy for them. I mean, you don't see that very often. I mean, $9.4 billion in profit.
I guess if it works for them, more power to them, I guess.
I just, the mortgage banker side of our industry, it plays very nice together. Obviously, that's the heart of our organization. So it's something that's central to me, but it's just amusing to me. The wholesale side of the business, so competitive. And I know that's a side of the business you used to be in, haven't been for a while, thinking about dipping your toe back in that arena. Just any observations on the two channels? And
yeah, I think we're right in the middle of relaunching wholesale, and our company started mostly wholesale back in 2007, and we shut it down in 2014. It got really competitive. The wholesale is one of those sort of feast or famine. I mean, the industry is a little bit like that in terms of its cyclicality, but more so wholesale in terms of feast or famine. And we do think that there's a place. There's just not every mortgage company, even the largest ones in the country, can't serve every nook and cranny in the communities in America. And so there is a very real place for mortgage brokers in America to be able to serve communities in all those, like I said, nooks and crannies of the community. I think for anyone getting into wholesale, it's really about efficiency, productivity, where you are in the cycle of your evolution of your business, especially from a access to capital, retention strategy, and just overall efficiency and productivity. You got to be ready for it. And I think we're ready to come back after 6 years of being out of wholesale, even though sometimes the margins can get a little thinner. It's up and down. And I think overall it works it can work. And so we're excited to get back into it. But I think there's a couple of areas in wholesale that I think those that were in it before or in it now or want to be in it, is there's kind of the partner side of wholesale, and then there's the traditional broker, like where they're using, it's like if you're using a rifle versus a shotgun. And the partner side is working with the right community lenders, right community partners that align with maybe your wholesale mission. For us, this is what it's like, our wholesale mission, and our overall mission, as opposed to sort of spray and pray and try to hit everyone. And I think for a company like us, we can be very successful in that focused area, of the industry and mortgage brokers in general.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by Panorama Mortgage Group CEO Jason Madiedo. Jason, I want to turn our attention now to Walmart. Made some headlines recently by announcing a large fintech endeavor, led some in the industry to speculate that they could be following the lead of Costco and other rumored entrants and potentially making a play into the mortgage arena. When you hear all these rumors, if it's Amazon or current participants or the Walmart thing, how do you view that? Is there one particular entity that it would maybe worry you just competitively if they were to get in the industry for the long-term future of the industry? How do you view that non-mortgage companies potentially dipping their toe into the mortgage waters?
Um, I'm not so worried about it in the short term. I don't know about the long term. I don't think any of us do. But this isn't the first huge, large company that is outside of our industry trying to take a stab at the mortgage industry. Microsoft tried it many, many years ago, even into real estate sales. I mean, it's not the first time. And I think there's two things that they haven't been able to figure out, and maybe not figure out really in the short term, of how to really sort of get in it in a big way. And one of those is something that we fight a lot as independent mortgage banks, and that is regulation. The regulatory environment in mortgage is a scary one for someone outside of the mortgage industry. You got to be a mortgage banker to really want to deal with the regulatory environment and the tail risk of mortgage. It's not just some customer returning a T-shirt back to the shop, right? It's a little different in mortgage, and Rich, you've been in capital markets in all areas of mortgage, and so I think that is one sort of barrier of entry as they start to dip their toes into the mortgage side of fintech, where there's a lot of unknowns. And I think the second thing is how fractionalized our industry is. You think there'd be some market share owner like Walmart. I mean, they own a significant market share in what they do, but there's really no one who owns a significant market share in our industry. Even those that have large market shares, that claim large market shares, if you think about their business, it's very horizontal. They have different business channels that drive origination to them. And so it's not all organically originated loans. There's partners, there's TPO, there's divisions, there's joint ventures. All these things that companies go horizontal in are driving that origination. And that origination is typically happening with belly to belly, boots on the ground in a lot of cases, especially in the purchase side. And so I think that fractionalized environment that we live in, where the real organic origination of a mortgage is probably a couple of percentage points in terms of any market share, I think that makes it really hard for them. Like I said, I think that's a short-term thing. I don't think they're going to figure it out in the short term. Long term, it's all going to depend on customer acquisition and the manufacturing process and regulation around the industry. Right? The first time one of these big companies makes a big mistake and has to deal with that, and we've seen a lot of mortgage companies deal with these, it becomes headlines. I don't know if they'll think it's as attractive as I think it is.
Thanks, Jason. I want to throw some things at you, try to keep my ear to the ground, things going on in the industry. I'm going to throw a couple things at you that, just I've heard as far as trends we could see as we get into the spring. And I've heard this one from a couple people, very large producing loan originators for mortgage companies spinning off to start their own mortgage companies. That one caught me off guard when I first heard it. Then I started to think about it and think about the income that the top producers made last year. Is that something you're seeing or hearing in the marketplace?
Yeah, kind of, right? I mean, I think about myself. I'm 30 years, almost 30 years. I'm like a year away from being 30 years in this industry. And, I think about myself and my desires when I was a loan officer for 15 years first. And so I think it sounds very attractive to loan officers, and I'm seeing it happen. However, I think once they start to see what it really takes and the levels of risk it takes and the amount of size of team and knowledge and skill you need for a mortgage bank, a fully functioning running mortgage bank, I think they start to maybe second guess it. Now, some will, and that's great. We need more blood and young blood in this industry, and I hope that some are successful at it. I think we also, though, I think what it's driving is us as independent mortgage banks, and I just say, speaking for independent mortgage banks, I think it's causing us to rethink our platforms and how we attract high level producers. Are we still going to be a platform of single name and single platform mortgage companies, or are we going to create a platform where they can connect to and really bring in what they want? And I think what they think about in terms of a top producing loan officer is culture. I think they want to control culture. I think they want to control competitiveness to the street. And so they want to be able to be competitive. And so you need an infrastructure that will allow them to manage that competition a little bit better. So I think those are the two big drivers. Some control around loan fulfillment, more control than just processing. I think that's one of them. It's a slippery slope in order for an independent mortgage bank to be able to provide that kind of platform. But I think you got to think about it and see what that looks like, because yeah, I think you're right. I think high producers are going, well, I did 500 million or billion, or I did even 300 million. What does that look like? That's a small mortgage bank, that could be, but it's scary, and it requires a lot of capital and a lot of capital risk. Not like when we started, where you just needed a few $100,000. Now it's in the millions, and so that's a little different.
Thanks, Jason. Next one I'm going to throw at you, joint ventures. I'm hearing we're going to see a ton of JVs spawned over the course of the next 6 months. I know you've done a couple of them. So your thoughts on JVs and why and if the time is ripe for them here into the spring and the summer?
Jumping into the JV bandwagon, I think, is a good one. It's not for everyone. My personal experience is as we looked at growing our company, first pass was, let's go horizontal. Can we add insurance and et cetera and all these other things? And then it's not as easy as we think, but and vertical, I meant, sorry. But horizontal is a little bit easier because it keeps you in your lane, so to speak. And so I think the key to a great JV is, one, having the right partner. I think we've been lucky in finding great partners in joint ventures with large firms that it makes sense for us to partner with, and it makes sense for them to partner with, and that there's a genuine understanding that it's not easy, that it requires capital, some patience, and that everyone in their own expertise should stay in their own lane. So relationship management's huge. The right partner is probably the key to everything. Just because your JV partner does volume, it doesn't necessarily mean it's a great outlet. And look, I think as IMBs, we have to think about the profit targets are somewhere in between a traditional distributed retail model and a wholesale model, but it's not as high as one and it's not as low as the other. And I think that's sort of the area that people have to look at from a JV perspective. But it is one of those situations that once you're married, it's very sticky, and really the customer acquisition changes a little bit, right? That's where you're getting the savings. The cost savings are coming in customer acquisition improvements, and it's a little stickier than a traditional retail branch. So, if anybody has any questions, I'm happy to offline to answer them.
Thanks, Jason. This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. I have about 15 minutes left with Panorama Mortgage Group CEO Jason Madiedo. Jason, the next thing, just hearing out there in the marketplace, obviously rates have ticked up a little bit. We were talking before we went live about the historical perspective on that. But obviously lenders staffed up to the gills, throughout the fall to winter, just adding as many people really as they could to get the pig through the python. And already hearing some lenders, just kind of talking about, okay, we're already a little overstaffed. Thinking about the future, thinking about technology and emerging tech that could further reduce human involvement, and talking about if it's cross-training staff or other ways to make their staff more versatile, more diverse, more cross-trained to help mitigate manufacturing costs going forward. What say you to that?
Man, that's such a great question, Rich. And I think it's got to be on everyone's mind right now. It's actually, to me, a bit scary. Now, we are experiencing a bit of a different experience. We're still seeing it hard to recruit and hire loan fulfillment staff, right? Processors, underwriters, closers, even loan officer assistants. I mean, across the board, it's not easy. So we're still seeing it. We're still seeing it highly competitive. And I think I've heard a few of the sort of layoffs, et cetera, Rich, and I think that's happening in some segments and some companies, but not at large. I think at large, it's still a little tough. I think, staff is still expensive. Cross training can be great, but it's always a redundant approach and a fail-safe approach. It's never it never seems to be a really good long-term approach. I think we all need to be really, really thinking heavily about um, artificial intelligence. Where can artificial intelligence take some tasks away to increase productivity? The cost of manufacturing, even though if volume would slow down and if the aggressive recruiting of loan fulfillment staff would slow down a little bit more, I don't think we're ever going to get back to the base pays that we were paying before. It may drop a little bit, but it's not going to drop all the way back, I don't believe. And so that is going to be the hardest part, because the manufacturing cost is still going to stay high. The volume might decline, compression might happen to some degree. And I don't know if cross training is the answer. I think that artificial intelligence and taking small tasks away to increase productivity and outsourcing is going to be what's going to decrease manufacturing for us as independent mortgage banks and all mortgage companies in the long run, because we're going to have to figure out very quickly how we can get an underwriter 30%, 40% more productive than they are today. And that's not going to be easy, not for everyone, because implementing a whole new way of doing things and that sort of change is not easy. But that's my perspective.
Thanks, Jason. Then you add the fact that, obviously the mix of new business walking in the door is more purchase heavy, less margin, obviously, in purchases. They're more complex deals to manufacture. What is your just general view on, let's just say, rates kind of stay where they are in the low threes, 30-year fixed, slowly tick upward this year. The general trajectory of refinances, how you see the purchase market in 2021, and how you see this year playing out just kind of globally as the CEO of Independent Mortgage Bank.
That's a great question. I think, it's all about the pivot. And I think so we've been lucky, I think that, and it's our mission and it's part of our focus, that we're about 65 to 70% purchase still, even in 2020. So that's coming from an 80 to 90% purchase mix on a usual year. So I think we will gravitate towards that. That's just our mission. That's what we're focused on. But I do think that there's a pivot about to happen And now that we have doubled our percentage in terms of product mix, or purpose mix, I should say, into refi, we're looking at that too. And so I think the pivot comes from looking at, cash out refis, looking at what's going to happen with HARP. Is there really going to be a HARP 3.0 for people coming out of forbearance? I think there's a market there, and I don't think they're going to be rate sensitive because their motivation is completely different. And so is the same for cash out. We do have a huge inventory issue. I think that looking at your product expertise, this is what we're doing, looking at our product expertise and finding the gaps and the holes where we don't have expertise in certain product, whether it's renovation or some other type of product that may be more attractive, that sales may need that ammunition, so that they can capture more market share in their community. That's I think what we're thinking. I think the market's going to be generally good. We're a heavy purchase shop. We're horizontal in terms of business channels and growing those. But I think the key is the pivot. Can your team pivot to a new product, and where are your gaps? And we found gaps in ourselves, and we're trying to close those gaps as quickly as possible.
This is the last week in Mortgage Today. Rich Swerbinski with the Mortgage Collaborative have 5 or 6 minutes left here with Panorama Mortgage Group CEO Jason Madiedo. And any questions, comments anyone has for Jason or I, please feel free to drop them in the chat or the Q&A, and we'll voice them aloud. Jason, turning our attention from volume to profitability, margin compression. We know obviously last year was an anomaly, a great one for our industry, very robust volume and margins. We all know that compression to profit margins is going to be a part of this year. Has it started already? And how do you see the year playing out from a kind of profit margin standpoint?
We haven't seen the effects yet. I hope we don't. Last time we saw margin compression, I think we were all doing this margin compression. It was 2018, right? And
I remember it being at conferences, it was like the drinking game. Every time you heard margin compression, you had to drink,
Yeah. I mean, we were all drunk every night.
Right.
So I'll say the same thing I said then. Is it margin compression or commission compression? And that's the defining difference, or the battle, I should say. A mentor of mine, I call him a mentor, but I've just known for a long time, Joe Garrett, said, the problem with your industry, Jason, is that the smartest operators have to compete with the most desperate, irrational, delusional people. And so we have companies to run. We have margins to hit, profit targets to hit, and I don't know what's going to happen, Rich. Are we going to get as desperate as necessary to compress the margin down to where we don't see the healthy profits we saw in 2020, or is it really a commission? Does it really address with commission? Hopefully, it's a balance of both. That you have to be competitive enough, and sales has to understand that there's good years and bad years, and everyone has to participate in that, I think, overall. So, if there's going to be less loans and less market, then of course there's going to be more competitiveness for that same loan. I think that it's going to compress in some way. That's one side of the equation. I think the other side of the equation is, what's the market going to do? How valuable are these assets are going to be? And man, look at the last week or so. Your guess is as good as mine. I think we're going to be okay, but it's going to depend on what the Fed wants to say and what day they want to say it, and what are they going to do and how are they going to behave? Are they going to flood the market with purchasing MBSs and making it super attractive, or are they going to back out at some point? I think there's just maybe too much unknown, because we're just coming out of a pandemic, and there's this pressure between inflation and recession that they need to balance. So at the end of the day, I'll do what my mom said when they asked her what's the secret to her success as a loan officer now for 40 years, closing 400 mortgages a year herself. Now she's like 70. to 80 mortgages a year. She said, there's no secret to this business. Just put your head down and work. Just prospect. Just go get more loans. So that's what we're going to do.
Refreshing advice. Last thing I want to touch on with you, Jason, is just the competitive landscape in general in our industry right now. I haven't seen like market share stats recently, but as of like pre-pandemic, the industry had gotten to like 50-50, almost dead on IMB and depository. But I think over the course of the last year, we've seen the money center banks, still kind of stay on the periphery, not jump in with both feet. I think community banks and credit unions, the good ones have continued to do their thing, and good lenders in those spaces have picked up a little market share, and those that don't have their whole heart in it probably lost a little. But we definitely saw IMBs pick up more market share. The big IMBs, the Rockets, some of the big wholesale lenders we were talking about earlier, the Calibers, the Loan Depots. I mean, my sense is that, now a lot of these companies are going public, raising lots of money, obviously to scale their business and to invest in a lot of the things that we've been talking about here that are the future of the industry. How do you view the competitive landscape in general as you commandeer your own company, which is been a very successful medium large size IMB, with all your larger competitors getting bigger with obviously national aspirations, you with your own national aspirations? Just very curious how you view the competitive landscape in general in the mortgage lending industry right now.
Well, it's interesting. I think a lot of these large IMBs going public is going to definitely change the dynamic of how the mortgage industry is going to evolve. It was always the challenge, or the change was always the big money center banks getting in and out of the market, because they can easily squeeze price. They have different motivations and value to a customer from a cross-sell perspective than a independent mortgage bank who doesn't have as much as they do. But now this dynamic is going to change the industry, because we're all going after the same loan. As I mentioned before, my perspective is we're a very fragmented industry, and I don't know how they're going to capture more of that business and still make their shareholders happy. Our goal last year, we did 1.8 billion, and we'd like to. Our goal is to hit 3 and then stay around 3 to 5 billion. We don't have those massive aspirations of 100, 200, 300 billion. I think it's going to change the acquisition game dramatically. I think that all these mortgage companies, these large IMBs going public, are going to have potentially a positive impact on multiples in mortgage companies. And I think that the competitive landscape is going to change by mergers and acquisitions, and possibly people, getting out. I said earlier about, these, when you talk about loan officers wanting to become mortgage banks. Well, I said, yeah, we need more young blood or new blood coming into the industry, because, when we look at the average age of our industry and the average age of an owner or CEOs, they may be looking at the industry differently. I'm looking at it going, I'm going to be here another 30 years or 25 at least. I don't know if everyone's looking at it that way. And so I think from a competitive landscape, could things come together? Could these public IMBs only maybe grow through acquisition? Possibly. I don't know if it's as easy to grow or as cost effective to grow through customer acquisition costs, maybe through company acquisition. So I think the competitive landscape will change that way. I think it'll change because money center depositories will decide when they get in and out, and it's all a regulatory decision, seems like. And now that we have a lot of public IMBs, or a lot more, I should say, they're going to change the dynamic of how they acquire volume, and that's going to have an impact, I think, overall. So, just my 2 cents, Rich.
Jason, as always, fascinating insight. Always enjoy talking about the business with you, and thanks for joining me this week.
Yeah. Thank you.
All right.
Appreciate it.
And to our attendees, thanks for joining us. And until next week, same place, same time, every Tuesday at 2 p.m. Eastern. This is the Last Week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. We'll see you next week.